It'll be my last lecture in this university to any MBA class.
Oh.
This is.
Going to Australia.
Until you come back, of course.
Until they kick me out of Australia.
Mm.
So, yeah. So anyway, leverage and beta. Think. I want to really understand what this corporate finance is about. Understand the risk. Remember we were talking about different kinds of risk? So think about the business risk and the financial risk. Liffey Valley. I'm going to have to change this example. Actually, I won't be using it anymore. So, Liffey.
Taxi.
Let's go to LT.
Kangaroo taxes.
Yeah, kangaroo taxi. The Yarra is the river, right? Yarra, Texas. Now, so for this taxi firm operating the boats up and down the Liffey, its business risks are what? Let's have an example. What are the risks? Give me one.
Boats break down.
Boats break down, like it. Weather, like it.
Fire.
Fire, somebody sets fire to the boat, yeah. Any more?
Tourist levels.
Tourist levels go up or down, yeah.
Low-cost submarines are
We put him in charge of
A bit far-fetched, but a risk nonetheless.
freaky scenario analysis. But that's what it's the risks that you haven't thought of. It's the unknown unknowns.
Chris has pirates.
Pirates, yeah.
You never know.
Where you go. Especially when you go.
Especially in Somalia.
There was actually a submarine in the Liffey for like a month.
Was there?
Yeah, the guy on the island.
Oh,
Did you
yeah.
see him?
Did he have a submarine?
Oh yeah.
Cool.
It was there for like a month.
I saw his picture on the front page of the paper, but I didn't actually go to see it.
Yeah, it was just I saw him.
But I came close to that as a student. I was part of UCD Rag Week. Where
Boat race.
Pardon?
The boat race.
No. We strung a rope from the north side of the Liffey to the south side. And then another rope under it. We tried to walk across the ropes. We tried to rope walk across. And of course, as you can imagine, we're all half drunk anyway. So when you get out on the rope and you realise you're holding onto the one on top, and nobody told the rope that has to stay on top. So the rope, you end up in the river in about 5 seconds. What's that got to do with this? Oh, business risk. Yeah. So the business risks associated with running that business are different to the financial risks. With greater proportions of debt in the firm's capital structure, and therefore less equity, changes in the operating income, which are about the business risk. Agreed? That's what's causing that. Have greater effects on earnings per share. We've just shown you that. That's what I've been showing you in all the last slides, the slope of that line. Greater financial leverage raises the effects of changes in operating risk on earnings per share. Okay? Capital structure means that the effects of changing in operating risk will alter earnings per share. So financial leverage does not raise operational risk, but it does raise financial risk. The firm could become stressed, even for a given level of operational risk. Financial leverage, therefore, is going to raise the firm's beta. And that's an intriguing one I'm going to leave with you. Financial leverage will raise the firm's beta, although it's not changing the fundamental business risk of the firm. A leveraged firm has a higher beta, and that's why I was the example that I did for the regulator here. I had to remember I had to delever British Airport Authority's beta, and then move it up to the beta that you would have for an airport that was levered the same as Dublin Airport, because we know that leverage affects beta. Modigliani proposition 2 is it's like angels dancing on the head of a pin relative to this, so I'm not going to bother about it. If you can understand what the Modigliani-Miller proposition 1 is about, the irrelevance, the conditions for irrelevance, and then be able to relax those to show when capital structure becomes relevant, and then be able to write about that, and then say in the real world then taxes are important, stakeholder agency theory is important, so pecking order becomes important, ownership control becomes important, taxes become important, and the other theories are very important. So that's all I want to say about capital structure.
Their model basically is on full information.
Yeah.
Okay, which is not the case.
Well,
The
it's
real
not.
world. Yeah.
Well, I mean,
but is that a comparison?
yeah, it's a very good comparison, because
Okay.
one of the things I said was full information. Asymmetric information, financial markets are full of it. So, I mean, the guy who's operating, think of any company that you're thinking of investing in. There is not a chance that you have the same quality of information as the financial manager of that firm. You don't know what, to what extent is he or she then going out for a cocktail with the accountant and saying, oh, you know, come on, cut us a break, give us a bit of slack here on the balance sheet, etc., etc., etc. In case I forget, that's information asymmetry. As investors, we never have the same quality of information as people inside the company. And therefore, a bit of leverage in the firm is keeping the bastards honest. So it's seen as a discipline on the firm by saying, I don't care what you guys think you're up to, but one thing you're going to do is pay back that debt, cash out, month after month. You've got to be earning enough operating income. Whatever you're doing in the books, you've got to pay that back. And so it's overcoming information asymmetry by imposing a cash discipline. Okay? And the exact same point, or parallel point, applies to the advantages of dividend policy. Because what it's saying is, the information asymmetry, we don't know what the hell you're doing in that firm, but you know, quarter after quarter, you're going to have to come up with hard cash and pay us back. And so it's seen as a very powerful signalling device, where the firm is saying to the shareholders, whatever about information asymmetry, we're going to deliver hard cash quarter after quarter. And that's an important theory of dividend policy. It's a signal of consistency, good financial planning and execution. We'll come back to these theories. What time will we come back at?
That's one question.
Sorry, Mike.
Just on the leverage and beta one, the last comment you made about financial leverage raised with first beta. Is that in the MM world, proposition one?
Yes.
Okay, because that's raising the cost of equity. So are they saying that there's more debt in the structure that they somehow balance out? Is that what they're saying?
That's exactly what they're saying.
Okay.
And in fact, there's some of the slides I haven't gone through. It actually says that. It's a good insight. What time will we come back? Half? Before? 25 past? Do you want to go 20 past?
No.
25 past.
25 past.